Remember the late 90s? This video only for you. The dial-up tone, the chunky monitors, and this feeling that a new world was just a click away. That was the dawn of the internet age, and with it came an explosion of excitement. A gold rush unlike any other. The dot-com bubble. Hi everyone, and welcome back to the channel. Today, we're going to rewind the clock to a time of wild optimism, insane valuations, and a historic crash that reshaped the digital landscape forever. How did so many companies, once hailed as the future, vanish almost overnight? Let's find out. It all started with a simple idea, really. The World Wide Web was becoming accessible to households, not just universities and government offices. And entrepreneurs saw a digital frontier, a chance to build empires from scratch. The thinking was revolutionary. Why rent a storefront when you can have a global one online? Companies with Dotcom at the end of their names started popping up everywhere. You had online pet stores like Pets.com, online grocery stores like Webvan, and a ton of others promising to change how we live, work, and shop. The media was buzzing, and Wall Street was listening. Investors, from seasoned pros to everyday folks, were desperate to get a piece of the action. The excitement was fueled by a new kind of business metric. Forget profits, forget revenue, forget traditional business models. The new buzzwords were eyeballs, user growth, and market share. The logic was simple. Get big, fast, capture as many users as possible, and worry about making money later. It was a get in now or miss out forever mentality. This led to some truly mind-boggling valuations. Companies that had never turned a single dollar of profit were going public and suddenly being worth billions. A company could literally just add .com to its name and see its stock price skyrocket. It was a frenzy. Super Bowl ads were being bought by companies that had only been around for a few months. It felt like a party that would never end. Let's take Pets.com as a classic example. They had a catchy sock puppet mascot and a brilliant marketing campaign. They raised over $80 million in their initial public offering. The idea was simple: buy pet food online and have it delivered to your door. Sounds familiar, right? But the problem was in the execution. They were selling heavy bags of pet food for less than they paid for them, and then paying for shipping on top of that. The business model was fundamentally flawed. For every dollar of sales, they were losing even more. Another infamous example was Webvan. Their ambition was even bigger. They wanted to deliver groceries to your door within a 30-minute window. To do this, they built massive state-of-the-art automated warehouses, spending billions on infrastructure before they had even proven the concept. They expanded to multiple cities way too quickly, burning through cash at an astonishing rate. The logistics were a nightmare, and the demand just wasn't there yet to justify the enormous costs. These companies were burning cash like it was going out of style, all funded by eager investors who believed the hype. The stock market, particularly the tech-heavy Nasdaq index, soared to unprecedented heights. From 1995 to its peak in March 2000, the Nasdaq Composite Index rose by over 400%. It seemed like everyone was getting rich. Stories of secretaries becoming millionaires overnight were everywhere. People were quitting their jobs to become day traders. The fear of missing out, or FOMO, was at an all-time high. But underneath all the hype, the foundations were shaky. These companies weren't building sustainable businesses. They were building speculative assets. They were focused on stock price, not on customer value or profitability. The party music was loud, but if you listened closely, you could hear the floorboards starting to creak. The turning point came in March of 2000. It wasn't a single event, but more of a gradual awakening. A few big companies started missing their already ambitious earnings forecasts. Japan entered a recession, and the Federal Reserve began to raise interest rates to cool down the overheated economy. Suddenly, investors started to ask the questions they had been ignoring for years. Where are the profits? When will these companies actually make money? The confidence that had propped up the entire market began to evaporate. The get-in mentality quickly turned into a get-out panic. People started selling, and as prices dropped, the selling intensified. It was a classic feedback loop, but in reverse. The Nasdaq, which had peaked at over 5,000 in March 2000, began to plummet. What followed was a brutal, drawn-out crash. By late 2002, the index had lost nearly 80% of its value. Trillions of dollars in market capitalization were wiped out. The dot-com darlings went from heroes to zeros. Pets.com, after burning through hundreds of millions, liquidated just 9 months after its IPO webvan declared bankruptcy in 2001, having lost over $1 billion. Hundreds of other dot-coms simply vanished, leaving behind nothing but broken dreams and a bitter lesson in market psychology. The fallout was immense. Countless investors lost their life savings. The tech industry, particularly in Silicon Valley, went into a deep freeze. Layoffs were rampant, and venture capital funding dried up. The era of irrational exuberance, as the former Fed chairman Alan Greenspan had famously called it, was officially over. For a while, the internet itself seemed like a failed experiment to some. But here's the most important part of the story. The dot-com bubble wasn't just a failure. It was also a necessary, albeit painful, step in the evolution of the internet. The crash cleared out the weak ideas and unsustainable business models. It forced the surviving companies to focus on what really matters, creating real value and building profitable businesses. Think about it. The ideas behind Pets.com and Webvan weren't wrong. They were just too early. The infrastructure, the consumer habits, and the technology for things like last-mile delivery just weren't mature enough yet. Today, companies like Chewy and Instacart are thriving on those very same business models. But with 2 decades of technological advancement and logistical learning behind them, and from the ashes of the crash, the true giants of the internet age emerged. companies like Amazon, which also saw its stock get hammered during the crash, survived because it had a long-term vision and a relentless focus on the customer experience. Google, which went public asterisk after asterisk the bubble burst, learned from the mistakes of its predecessors and built its empire on a solid, profitable advertising model. These companies and others like them were forged in the fire of the dot-com bust. So, what can we learn from all this? The dot-com bubble is a powerful reminder that hype can't replace substance. A cool name and a big marketing budget are no substitute for a sound business plan. It teaches us about the dangers of herd mentality and the importance of doing your own research instead of just following the crowd. But it also teaches us about the resilience of innovation. The vision of the dot-com era connected world where goods, services, and information are available at our fingertips was not wrong. It was just ahead of its time. The crash was a painful but vital correction that ultimately paved the way for the stable, powerful, and integrated digital world we all live in today. Thank you so much for watching. What are your memories of the dot-com era? Do you remember any of those now defunct websites? Let me know in the comments below. And if you found this look back at tech history interesting, please give this video a thumbs up and consider subscribing for more deep dives. We'll see you in the next one.